Deckers Outdoor reported their earnings, and in regular trading hours, the stock was down 19%. Very, very ugly price action, actually dipping below the $100 mark to finish the week off in what has been an ugly day and an ugly year, with the stock down about 50% on the year. So we are going to talk about why that is, what was the issue in this earnings, and is Deckers Brands a buy right now? But before we dive in, if you could please go ahead, like and subscribe. It really, really helps me out. But let's first dive into what Deckers Brands or Deckers Outdoor do. Now, they are a footwear designer and a distributor founded in 1973 based in California. The company's portfolio of brands include Ugg, Teva, Hoka One, and Kookaburra. Now, the majority of their revenue actually comes from the Ugg boot brand. Hoka One makes up the second biggest segment, but it is growing the fastest. And then the other brands make up only 7% of total revenue. Now, the earnings was actually pretty good for the quarter. The company beat on revenue expectations as well as EPS expectations, growing revenue 6.4% quarter over quarter, and growing EPS 21.4%, smashing the estimates on both sides. Gross margins increased ever so slightly. As you can see right here, net income margin increased as well, and this translated into net income dollars also increasing from 127 million to 152 million respectively. Now, free cash flow saw a massive step up from negative 4.5% free cash flow margin to 17.6%, and that resulted in the company reporting $183 million in free cash flow. So the company's balance sheet is also very, very solid. $1.89 billion in cash, $279 million in debt, a very prudent balance sheet. And the company, when you look at these headlines, firing on all cylinders, if you ask me. They are growing, expanding margins, turning profitable, and the balance sheet is great. So why was the stock down 20% after the earnings? And it had to do with their guidance. Now, the company's guidance for the next quarter came in significantly weaker than expected. The company was guiding for about 890 to 910 million in the next quarter. I think the market wanted a 925 million midpoint. So essentially what we saw was a lower of the guide relative to expectations. And then this is what really tanked the market, in my opinion. Earnings per share came in at 62 to 67 cents. That's what management guided for. The market was looking for 79 cents in this arena right here, 79 cents at the midpoint. So when you get a guide lower because of trade policies and macroeconomic uncertainty, the market is going to sell you off like it did here, down 20% on the day. Very, very ugly price action. But to be honest, the business is still looking to grow about 8% on this quarter. So this isn't a brand that's falling apart. It's just that growth came in a little bit softer than what the market was expecting. But we also have to ask the question, why did the company guide lower? What are they seeing in their financials? What are they seeing in the business? And there could be multiple reasons, ranging from the consumer pulling back, competition, is the business losing market share, tariffs. And when that type of uncertainty rears its head in any business, the market acts irrationally by selling first and asking later. Now, diving into their financials in a more granular fashion, so you can see their net sales quarter over quarter increased 6.4%. Cost of sales only increased 5.2%, and that resulted in gross profit increasing 7.4%. Very solid stuff, great cost control in what has been a tough year for the fashion industry. Going down further into SG&A, that only increased 2.5%, and as a result of that cost control, net income was up 18.8%, and that is why you actually saw earnings per share increase 20% despite net sales only gaining 6.4%. Now, diving into the segments more broadly, the Ugg brand right here increased 13%. Now, this is for the full year, guys, not the quarter. So Ugg increased 13%, Hoka increased 23% for the full year, and then the other brands saw a decrease of 8.6%. So, the growth engines of Deckers is Ugg and Hoka. Looking at channel, wholesales increased 17.4% and direct-to-consumers net sales increased 14.8%. DTC comparable net sales increased 13.4%. So they are seeing some very, very solid growth, but again, it's primarily driven here by Ugg and Hoka. Looking at geography as a whole, domestic net sales, so this is the US, increased 11.3%, and the international sales increased 26.3%. So the international segment really is a growth driver, but the company is still firing on all cylinders, seeing double-digit growth across the board, except in stuff like the Tiva brand, which actually decreased 8.6%. Now, Decades Management also announced that they're going to expand their share buyback to $4.5 billion. They increased it by $2.5 billion. And if you look at all of the authorization, if they were to plug all of that in and buy back the entire company in the here and now, it would represent about 27% of the company. So they are looking to buy back a lot of shares while the stock is down and the valuation is very attractive. And to be honest, the valuation looks attractive on some metrics, not that attractive on others. They have a 2.5% shareholder yield, price to earnings ratio, last 12 months of 20.1 times, and an EV to EBITDA of 12.7 times. So looking a bit expensive on a price to earnings basis, but on an EBITDA basis, right, looking actually pretty cheap if you ask me, especially for a company growing double digits with 20% free cash flow margins. So that's what we're going to use to value the company, 20% in free cash flow margins. And if we plug that in going to 2029 with 7% revenue growth, which in my opinion is a little bit conservative, I think the company can continue to grow at about 10% through 2029. And then if we actually just use a 17 EV to free cash flow, the current EV to free cash flow is about 20. So we're seeing slight multiple contraction. Then we subtract the net debt, we get the equity value and divide by shares outstanding. I'm assuming shares outstanding will decrease 2% sequentially every single year. We get a 2029 stock price of $189. That would represent 13% year over year growth compounded annually. And that puts the fair value discounted at 15% at $94. The stock is at about $100 right now. So definitely at that fair value range. And you could say that these are actually some very conservative estimates. In fact, I think free cash flow margins can probably go to 24% if the management really gets their costs under control. If they buy back a lot more shares, which they certainly can, you could see this number change. And if they do grow above these numbers, you can see tangible upside to this number right here. But that's all going to have to come from margins and growth, as well as the shares decreasing and not necessarily the multiple, because I think 17 as a multiple may be a little bit rich for a company like this. I think maybe closer to 15 would be appropriate, but you know, you could say that the company is probably trading at fair value right now. Looking at the technical charts, if it is a buy, I mean, realistically speaking, this is probably where you should find support. If you do find a little bit of support here and the stock starts to get some strength, you could probably look for the closure of this gap, call it the 120, 125 level. Closure of this gap with the stock trading at $100 would mean 25% upside. And then you would still have the all-time highs up here and the retake of the 200-day moving average. That being said, I think technically this looks like a great spot to buy. The company is fairly valued on certain metrics, cheap on others. I think if you are looking for a high quality stock and you're willing to sit through a bit of volatility and stagnation in the stock price, Deckers Outdoors is the stock for you. And I would say that, yeah, it's a buy right now, especially if we find support at these levels. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.